Hi, and welcome to Devil Wears Data, where I break down interesting and important research in a way that actually makes sense to you. Today, I'm starting a new series on CEO hypocrisy. In this series, I'll walk you through research that helps us understand how often CEO act in hypocritical ways and why. Now, a quick disclaimer here. Throughout this series, I'll be talking about average CEO patterns. That does not mean every CEO is a hypocrite. It means that the research looks at broad trends, not every individual case. Now, the reason I want to share this research is because CEOs have a huge amount of power. They lead major organizations, shape company decisions, and influence the market in ways that affect all of us. But most of the time, we only see the outcome. We do not always see the incentives and the causes behind those outcomes. And that is what this series is about. I want to help you understand some of the underlying forces that can push CEOs to act in opportunistic ways. Once you see those forces more clearly, some of the things in the market will start making a lot more sense to you. For example, let's take Tesla. A lot of people bought into the promise of advanced self-driving features of Tesla, technology that would make driving less mentally exhausting by helping with things like staying in the lane and detecting obstacles. Now, that was the part of the appeal for buying a Tesla car. But over time, access to some of those features became tied to a subscription. In the US, that subscription is about $100 a month now. If you don't pay the subscription, basically your Tesla is as good as any car from the 80s or the 90s, except for it's electric. So the question is, why move to that model? Why promise something and then later put it behind a monthly fee? By the end of this video, my goal is that you will have a clearer sense of it. In today's research, we are looking at product recalls in industries regulated by the US FDA or the Food and Drug Administration. That includes food, beverages, medical devices, and pharmaceuticals. And these are not minor recalls. They involve products that can cause major harm and even death. So, when a company issues one of these recalls, it means something seriously has gone wrong. One example is the New England Compounding Center. A contaminated batch of steroid injections was linked to a fungal outbreak that killed more than 60 people and sickened hundreds more. So that is the level of seriousness we are talking about here. Now, here is the key finding from the research. The more a CEO's pay is made up of stock options, the more likely the firm is to experience one of these serious recalls. And not just that, firms with more CEO stock option pay also tend to have higher number of recalls in a given year. Now the question is, why is that? To answer that, we need to understand what stock option pay actually is and how these stock options work. At the most basic level, this is an incentive story. Economists began seriously thinking about this in the 1970s. Their basic question was, how do you get CEOs to act in the best interests of shareholders? Their answer was, a CEO is an agent working on behalf of the shareholders, but because shareholders do not directly control CEO's every move, there is always a risk that CEO may act in their own interests instead. So how do you deal with that? There are two broad approaches. One is monitoring. You keep a close eye on the CEO and make sure they're doing what the shareholders want. The other is incentives. Structure the CEO's pay so that when shareholders do well, the CEO does well too. That second idea became hugely influential. For instance, a major portion of Elon Musk's pay is in stock options. A stock option gives a CEO the right to buy a company stock later at a fixed price, called the strike price. In order to understand this, here is a simple example. Imagine a CEO is granted stock options with a strike price of 100. That means later on, they have the right to buy the company stock for 100 per share. Now let's say the stock price rises to 120 because the market likes the CEO decisions. The CEO now can buy at 100 and sell at 120, making a $20 gain per share. Now imagine the opposite. Let's say the stock price falls to $80. In that case, CEO would not want to buy at 100 because the stock is only worth 80 in the market. So they simply do not exercise that option. And that is the key point. When the stock goes up, CEOs can gain, but when the stock goes below the strike price, the CEO does not lose money in the same way. They can just walk away from the option. And that is what makes stock options asymmetric. The upside can be very large, but the downside is limited. And that kind of payoff structure can encourage careless risk-taking. It means the incentive structure can make risky decisions more attractive and make the costs of failure feel less consequential. If new product succeeds and market responds well, the CEO can benefit a lot through their stock options. If things go badly and the stock price falls, their options may simply end up worthless and they do not have to exercise them. So the gains are theirs to keep while the losses are limited, and that is the mechanism this research is pointing to. The basic idea is simple. The asymmetric structure of stock options can push CEOs towards bigger bets. They have a strong incentive to chase big upside, to really kick the ball out of the stadium, so to say, while feeling much less exposed to the downside. And once you understand that, Tesla starts to make a lot more sense. Why is Tesla moving features like advanced driving tools behind a subscription? The logic is, in the last shareholder meeting, a new compensation structure for Elon Musk was approved, in which he had subscription-related targets. In other words, some of those options would only become exercisable if Tesla hit certain subscription goals. And that creates a very powerful incentive. If CEO stock options depend in part on growing subscriptions, then of course there is going to be pressure to move more features into recurring paid services or subscriptions. So what may look like on the surface a product decision or a pricing decision is actually an incentive story. So now we can see more clearly how stock options can shape CEO behavior in very direct way. Now, this raises some obvious questions. The first question is, if this research shows that CEOs with more stock options are linked to more serious product recalls, and those recalls can hurt or even kill people, then should these CEOs be prosecuted? And the answer is unfortunately no, not on the basis of this research. What the study shows is that there is a systematic pattern firms with more CEO stock option pay tend to have more serious product recalls, but a pattern in the data is not the same thing as legal proof. You cannot take this study into a court of law and use it to prove that a specific CEO caused a specific product failure because of their option pay. So, what this research gives is not proof of criminal wrongdoing, but a way to understand the incentives and the recurring patterns. Now, the second question is even more interesting. You might say, hold on a second. If stock options are supposed to push CEOs to raise their stock price, and there is no criminal wrongdoing being proven here, then aren't CEOs just doing exactly what they were paid to do? So what exactly is the problem? Why call it hypocrisy? Why call it harmful? And that is the question I want to take up in the next video. Because the next piece of research shows something even more interesting. Stock options do not always just push CEOs to act for shareholders. In some cases, they can actually put CEOs to act against their own company's long-term interests and even against their shareholders. See you next time with another episode of Devil Wears Data.